The structural wave currently driving Anthropic is defined by the fastest commercial technology scale-up in recorded history. By April 2026, the company reached $30 billion in annualized revenue, growing to $47 billion by mid-May of the same year. This trajectory represents a daily revenue addition of approximately $96 million. To contextualize the scale, Anthropic's revenue run rate now exceeds the trailing 12-month revenues of the vast majority of the S&P 500, despite the company not existing 5 years ago. This megatrend is driven by the migration of cognitive labor from human hours to model tokens. In this environment, enterprise tasks such as spreadsheet analysis, legal reviews, and software engineering are being redefined as token consumption events. Unlike consumer applications, enterprise infrastructure operates as a utility, where switching costs are exceptionally high. Re-engineering workflows and revalidating outputs create a capital expenditure like lock-in, making compute budgets a durable and predictable revenue source. Anthropic specifically addresses the trust deficit inherent in large language model deployment. Early models suffered from hallucinations and unpredictability, which served as existential blockers for deployment in regulated industries like finance and healthcare. Anthropic's constitutional AI framework and interpretability research provide the technical architecture required for organizations such as KPMG or Salesforce to satisfy internal risk committees. This focus on safety and auditability drives an enterprise revenue composition of 80%, which is double the concentration seen in major competitors. By providing a system that can be justified to regulators and boards, Anthropic transforms AI from a speculative experiment into a deployable corporate asset.
The competitive moat for Anthropic is anchored in integration depth rather than isolated product features. Once a Fortune 500 entity integrates Claude into its operational nervous system, spanning internal code bases, customer service stocks, and document management, the transition cost involves 6 to 18 months of reintegration and recertification. 8 of the top 10 Fortune 10 companies are currently Claude customers, with over 1,000 enterprises spending more than $1 million annually. This industrial-scale switching cost mimics the defensibility historically seen in legacy database providers like Oracle. Furthermore, the safety brand acts as a regulatory moat. As the EU AI Act and federal procurement standards demand higher auditability, Anthropic's investment in interpretability becomes a de facto licensing requirement that competitors cannot quickly replicate. Financially, the bull case hinges on a transition from a 40% gross margin to a projected 77% by 2028. This requires inference costs to decline faster than pricing compresses, aiming for a trajectory of $2.10 in revenue per compute dollar. Claude Code, the agentic coding tool, serves as a primary growth engine. It reached an $8 billion run rate by May 2026, compounding roughly every 6 weeks. This product captures agentic compute demand, which is significantly higher per developer than standard chat usage. Investors must note the revenue sourcing model. Anthropic books cloud reseller spend on a gross basis, similar to Stripe or Shopify. A transition to net revenue reporting during IPO due diligence could reduce the headline annualized revenue by 20 to 40%. Sustained growth toward a $93 billion run rate by 2027 depends on multi-year agreements with partners to bring 3.5 gigawatts of capacity online.
Significant execution risks counter the growth narrative, primarily regarding the margin gap. Achieving 77% gross margins within 2 years is historically unprecedented for frontier AI labs. Analysis of the compute cost structure reveals that a ramp-up discount for the SpaceX Colossus infrastructure coincides precisely with the quarter's Anthropic cites for operating profitability. If full-rate costs reintroduce significant losses post-IPO, the current valuation may face a sharp reset. Additionally, customer concentration is a primary risk factor, as the revenue is heavily weighted toward a small number of Fortune 10 companies. Beyond internal execution, commoditization poses a threat. If open-source models achieve capability parity, Anthropic's pricing power could evaporate, forcing competition on distribution where incumbents like Microsoft and Google hold structural advantages. Geopolitical risks are also evident. In June 2026, the U.S. Commerce Department restricted exports of Mythos-class models following security concerns, revealing that advanced research can be restricted by regulatory action without notice. Furthermore, a dispute with the Pentagon over safety restrictions has limited access to the U.S. defense budget. A rational investment verdict requires analyzing 4 specific disclosures in the upcoming S1: the gap between GAAP-recognized revenue and run-rate ARR, the full-rate cost structure of the SpaceX agreement, the mechanics of related party transactions with Google and Amazon, and the governance power of the long-term benefit trust. The trust, controlled by financially disinterested trustees, has the legal authority to prioritize safety over profit. This governance structure has never been priced by public markets at this scale. Investors should wait for these GAAP-verified data points to determine if the headline figures represent a defining technology company or a derivative on optimism.